The guest that you will hear out on the show today, Jyotivardhan Jaipuria, Head of Research at Bank of America Merrill Lynch Capital, would be joining us with his sense of the fundamentals, as would be P. Fani-Shekhar, Fund Manager of PMS at Angel Broking. And on technicals, we would have Sandeep Bagle, Founder and MD of Aptar Technical Advisory Services. Okay, gentlemen, thanks so much for joining in, all three of you. Jyoti, I'll start off with you. What is it that you're expecting in terms of the market's move? Because we've been pretty lackluster all of this month, despite what we did in January. Does it seem like the market could go higher from now up till the end of the fiscal year?
Yeah, see, I guess we have to keep this in context that what we've seen is India has been one of the best performing markets over the past 1 year. A lot of the returns in the last 1 year have been led by re-rating of the market and not so much earnings. Because we got reforms coming in, there were expectations that the economy is probably bottoming out. So we've seen a big move come in on the back of that. Now what we are seeing is like FII participation has been huge in the market. Domestics are still not putting in money. At the same time, there's a lot of supply of paper which is coming up now. So it is that supply which is in some sense putting a check on all the FII flows which are coming in. And that's why what you're seeing is market in a range. My view is like if we take a next 6 month, 12-month view, probably a lot of the re-rating of the market is over. We'll get returns which are led more by earnings growth. Everybody now expects a recovery in earnings in economy, and I think over the course of the year we are looking at markets giving a return of around 12%.
So Jyoti, where do you foresee maximum earnings recovery then?
What we are looking at is some of the rate sensitive sectors will start doing better than what they were doing last year. So autos is one probably of our biggest overweight bets. And that's something where we see as the interest rates start to come down, autos will start to recover in terms of the volume growth, because volumes have been disastrous over the last 1 year. Second is we are quite positive on the banks. We think that's again another cycle which will start improving. Both the public sector as well as the private sector should do better than what it did last year. So these would be, I would say, two sectors which we are quite positive on.
Okay, that's the macro. Let's focus a little bit on the micro as well. P. Fani-Shekhar and Sandeep Bagle also with us. Funny, come to you really, and the kind of bounce back that we saw in some of the key rate sensitive names today. I don't know if you looked at the DLF analyst meet takeaways and the kind of verdicts that came out from the sell side community, but were you impressed with what they said, and what's your call on the stock?
Well, I'm not really convinced by what has been happening generally. I'm not limiting my point just to DLF, but in generally along that entire real estate basket, and as an extension the rate sensitive space. Because I believe that there is still significant challenges. Even if interest rates come down, it's not so easy for many of these rate sensitives led by autos or within or commercial vehicles which are dependent on investment cycle or real estate to increase the volumes on the ground, because as this quarter's earnings and sales have actually shown you, although we would like to believe that things have bottomed out there, but even the January numbers that we have seen are not giving us much hope. So I think that this kind of lackluster subdued demand on the ground is likely to continue for some more time, and notwithstanding the upbeat commentary that some of the companies are giving, I would tend to believe that at least 2 more quarters you will see this kind of subdued volume growth on the ground, which actually snuffs out any chances of any more re-rating from these levels.
A strong traction, Sandeep, in a couple of these names. DLF, of course, on back of all the analyst reports as well coming out, but JP Associates showed a bit of a bounce too. How do these two stocks look on the charts?
Well, DLF looks the best of the lot, Neeraj, for a move up to 275. JP Associates, I am not too sure. I think this is a bounce back move. At a level of 74, I would talk of a level of 77, 78, maybe at the most 80, nothing beyond that. So yes, a bounce back of 7-8% upside is what they look like.
Funny, the other set of stocks which gave off some of the gains were the oil marketing companies, particularly BPCL. Maybe the market already knew that, hey, there's going to be a rate hike, and therefore just a small upside at the start of the trading day before giving up all the gains. How do you look up to all that's happening in this space? Because the company clearly came out and stated that they do not need government approval. They will be able to hike prices at the end of every month. Is this something that makes you happy for the OMCs? Would you make an investment case here?
Well, on the face of it, it is certainly welcome after whatever we have seen over the last 3 years. But oil marketing companies, although will benefit a little from this sort of partial deregulation or gradual deregulation of oil sector, but I guess the main trade lies in the upstream, because oil marketing companies never suffered the direct brunt of under recoveries, because they were mainly suffering from the mismatch in the timing of the cash flows, because of which there was debt on the balance sheet leading to higher interest outgo. The actual brunt of the under recoveries was taken by the upstream. So I guess any deregulation in oil and gas prices would actually benefit the upstream companies more than oil marketing companies. That is something that we have seen over the last 1.5 months in the kind of rallies in both the spaces. So my trade will be more in upstream than OMCs.
And Jyoti, I just want to get you in about the whole rally that we're speaking about. There has been a bit, of a correction before the budget. Are we in for a strong post-budget rally? Could that come about?
Yes, the way I look at it, budget is just one more of the milestone. Ultimately, markets will do what earnings make it do. So as long as we get an earnings recovery, whether the markets rally ahead of budget, after the budget, or they rally, 3 months later, markets have somewhere like a final destination which will be fixed. Whether that destination is it goes up, down, it rallies in 1 month, or it rallies over the course of 6 months. I don't think that's as material really.
Okay, something off budget, and that spooked Jet Airways today, funny, was the talk of how the deal could get delayed to as much as March. And the reaction was understandable. A lot of trading positions, almost 5-6% in 2 days ahead of the deal. Now that it has been deferred, is this just a trading setback to Jet Airways, or would you avoid the space completely?
Well, I'm not a strong votary of investing in this space anyways. Much of the excitement was only for traders, and that obviously because of deferment of the deal is understandable. And in a deal of this nature, it's quite evident that both the parties will have expectations. Jet is bargaining for a good valuation. Etihad is bargaining for more favorable terms in terms of higher board representation. So these kind of hiccups are understandable. So this is part of the risk that traders have to take as when they are building positions. As far as investors are concerned, I don't see any merit in investing at whatever valuations Etihad picks up a stake in Jet, as long as your investment horizon is 3 to 5 years. And I don't think anyone invests beyond that as far as a minority investor is concerned.
No, which is a fair call. Some trading stocks, Sandeep, and which showed a lot of traction today. There was MMTC, there was State Trading Corporation of India, and there was this entire sugar pack. Renuka, Bajaj Hindustan, a couple of others had a good bounce. Anything which caught your eye?
Renuka has caught my eye. In fact, we have been bullish on the sugar space from Friday. On Friday, we had recommended. In fact, today morning we had recommended a Balrampur Chini, which met its target intraday. Renuka is still looking for a 5-7% upside. So, as a trading buy, yes. Over the next couple of days, yes. But nothing beyond that. MMTC, STC, they move 8, 10, 12, 15% in a given day, and then they move sideways or correct. I mean, that has been their pattern over the past few months or so. So I would not get into this space. I mean, the risk is higher in this stock, so I would avoid these stocks.
What do you do with sugar? There's talk of decontrol coming by. Prices are at the trough. Levy could go out completely of the window. The stocks are trading at lower levels. Do these merit an investment case, Funny?
Very difficult call, because first you have to understand what is the government's definition of deregulation. Does it want to stick with the Rangarajan panel committee recommendations, or it's devising its own definition of what they mean by decontrol? So we are still unclear about that. Prices have really troughed, and there is a good chance that they might go up by 10 to 15%, and that's a given. Levy quota might also go down. But is that sufficient for an investor to make money, considering the fact that many of these sugar company balance sheets are in a very, very bad shape? That's something that I'm not really clear of, considering the fact that the next sugar cycle also may not be very promising. So on the balance, I would give it a pass.
Fair call. The other set of stocks which actually the set of stocks which didn't have a good day today was the oil and gas pack, because ONGC too corrected in the session. Two-wheeler stocks like Bajaj Auto corrected in the session. So those were some loose points. The ones on the index which did well, aside of DLF and JP Associates, were some of the metal names. So Tata Steel did okay, Sesa did okay for itself, L&T didn't have a bad day either, and Cairn India up 1.5%. Funny, what's the call here? It's kind of broken the correlation Cairn India has with the crude price movement, because crude is at whatever it is, northwards of 115. The stock is down just about 1.5% higher today. Does this merit an investment case? Looking at the approvals that it is getting, looking at where crude is trading right now, would you look at Cairn India?
Yes, that's very promising in that entire large cap universe, because as you rightly pointed out, it's broken the correlation, and it is surprising because it's one of the better companies, and it was stuck because of lack of approvals, but since one is expecting approvals to come thick and fast, also because the government of late seems to be worried about the lack of capital investment, and this seems to be low-hanging fruit for them to pluck. So I guess Cairn India is right up there as far as investing is concerned, among the large caps at least.
Okay. The other stock which did very well today was GVK Power, and of course that had reasons of its own. We'll talk about that stock in the other segment, but you know, it just brings into focus the whole infrastructure and the road space as well. Talk of the PMO meeting the NHAI and some bit of traction coming in. And Sandeep, that had brought some of these road construction companies in focus today. IRB was up and about. IL&FS Transport didn't have a bad day. What do you do with some of these construction companies?
Neeraj, these stocks have bounced back from an extreme oversold zone, and when the stocks bounce back from extreme oversold zones, there is a tendency to give a sharp up move, but that may not last all the times, and I see more of this phenomena occurring. So I would not be too gung-ho about getting into this space, or even if I get into any of this, that will be for a short trading upside for a day or two, nothing beyond it. I mean, I have serious doubts. Yes, unless something changes in the budget and they start making weekly higher top, higher bottoms, that could be a different scenario, but then I think that will be post budget, not at the current moment.